With gold at record highs, are you wondering how you can start investing in this valuable commodity without actually purchasing gold directly? Enter gold ETFs, a fantastic way to get exposure to gold without the hassle of physical bullion. In this video, we'll break down the benefits and possible drawbacks of gold ETFs. We'll narrow down the list of candidates to invest in, and finally, we'll go over what I think are the best gold ETFs to invest in. So buckle up, gold prospectors, because we're about to strike it rich with knowledge. Before we jump into specific gold ETFs, let's rewind a second. ETFs, or exchange-traded funds, are essentially baskets of securities that trade like stocks on the stock market. A gold ETF holds physical gold, and you buy shares of that ETF to gain exposure to gold prices. So what are some of the benefits of gold ETFs, and why could investing in a gold ETF make sense for you instead of buying physical gold? First up, liquidity. ETFs can be traded throughout the day, making it easy to buy and sell your holdings. Purchasing and selling real gold, on the other hand, can be challenging, requiring it to be shipped to and from either you or a dedicated storage facility. The second benefit, security. With gold ETFs, you don't have to worry about storing or insuring the physical gold you purchase. Both storing and insuring physical gold brings an additional expense. Another benefit of investing in gold ETFs is that they are cost effective and they allow you to invest in gold in much smaller amounts. ETFs typically have lower fees compared to buying physical gold, and with an ounce of gold currently over $2,300, you can invest in a gold ETF with a much smaller amount, allowing you to tap into the gold market with a lot less money. And the final benefit, which is true for gold ETFs and physical gold, would be diversification. Investing in gold adds a layer of diversification to your portfolio, potentially reducing your risk. Now, I can't just give you the good news or benefits of gold ETFs without talking about some of the possible drawbacks as well. I got to give you the whole truth. So what could possibly be a drawback to investing in gold ETFs? The first drawback is counterparty risk. You're probably wondering, what in the world is counterparty risk? Basically, the value of gold ETFs are tied to those financial institutions that maintain them and their ability to hold physical gold. As an investor, you could incur losses if the institution faces financial challenges or fails to meet its obligations. So prior to investing, it's important to consider the reputation and stability of the financial institution maintaining the gold ETF. The other drawback could be expense fees depending on the ETF. For example, the FT Best Gold Strategy Target Income ETF, that's a mouthful, with the ticker symbol IGLD, has an expense ratio of 0.85%, which is really high, especially when equivalent or even better gold ETFs have much cheaper expense ratios. And before we dive into the actual ETFs, let me know in the comments what other investments you'd be interested in me covering. And don't forget to like and subscribe so that YouTube algorithm knows that they got it right showing you this video. Now that we've gone over the benefits and possible drawbacks of gold ETFs, I did want to show you how gold ETFs have performed compared to the S&P 500, with it being a known and good metric to stand against. For this comparison, I'll be using State Street's Gold Shares ETF with the ticker symbol GLD, but the returns of the top 6 I'll reveal later would all have very similar returns as GLD. We will be comparing GLD with State Street's S&P 500 ETF named SPY. Year to date and over the past 3 years, gold has slightly outperformed the S&P 500, but when you expand that time frame out to 5 and 10 years, you can see that the S&P 500 has outperformed gold, especially over the last 10 years. And looking at those returns, does that mean you shouldn't invest in gold ETFs? Absolutely not. Remember, diversification is important, and gold ETFs can give you that and still earn a decent return as well. So let's get into those gold ETFs and get the details you want to hear the most. There are currently a total of 10 gold commodity-based ETFs, but I'm only going to be considering 6 of those based on my requirements that the ETF have an expense ratio of 0.40% or less and have at least $1 billion in assets. And based on that criteria, the following ETFs didn't make the cut. VanEck Merck's Gold Trust with the ticker OUNZ, Goldman Sachs Physical Gold ETF with the ticker AAAU, ProShares Ultra Gold ETF with the ticker UGL, it's very close to ugly, Franklin Responsibly Sourced Gold ETF with the ticker FGDL. There are also some other ETFs related to gold investments that focus on investing in gold mining companies or focus on a mixture of physical gold and other cash-like investments to help create some cash flow in form of dividends to the shareholders. One of the more prominent ETFs for gold mining related assets would be VanEck's Gold Miner ETF with the ticker GDX. But I just can't recommend that due to its relatively high expense ratio and really poor returns. iShares Gold Strategy ETF with the ticker IAUF is an ETF that combines a portfolio of gold with other cash-related investments and treasury notes and does a pretty good job of mimicking the other strictly gold-related ETFs in regards to returns. But it does trail those strictly gold ETF returns, even with the nice dividend yield it boasts that's over 10%. So we've discussed briefly some of the other gold ETFs like GDX and IAUF, as well as the ETFs that we ruled out because of high expense ratios or a small number of assets. And that leaves us with the most important part of the video, the top gold ETFs that invest strictly in physical gold. I'll go over each one of these in the order that they were created and then tell you which one I would invest in and why. First up is the oldest gold ETF, being State Street's SPDR Gold Shares with the ticker symbol GLD, which is probably the best ticker of the group. But there are some others that are pretty catchy as well. GLD was created in November of 2004 and currently has an expense ratio of 0.4% and has gold assets totaling over $62 billion. Next up is iShares Gold Trust with the ticker symbol IAU, which, in case you didn't know, is taking advantage of the periodic table for the element gold, which is AU. IAU was created in January of 2005, so just a few months after GLD, and currently has an expense ratio of 0.25% and has gold assets totaling over $28 billion. Third on the list is Aberdeen's Physical Gold Shares ETF with the ticker symbol SGOL. SGOL was created in September of 2009 and currently has an expense ratio of 0.17% and has gold assets totaling just over $3 billion. The fourth gold ETF on the list is Granite Shares Gold Shares with the ticker symbol BAR. Another good ticker symbol, since most people likely envision gold bars when they think of gold. BAR was created in August of 2017 and currently has an expense ratio of 0.17% and has assets in gold totaling over $1 billion. The final two gold ETFs are what I consider little brothers to ones we've already mentioned in GLD and IAU. They are State Street's SPDR Gold Mini Shares Trust with the ticker symbol GLDM and iShares Gold Trust Micro ETF with the ticker symbol of IAUM. GLDM was created in June of 2018 and currently has an expense ratio of 0.10% and has gold assets totaling over $7 billion. And finally, IAUM was created in June of 2021 and currently has the lowest expense ratio at 0.09% and has gold assets totaling just over $1 billion. So why did State Street and iShares create additional ETFs that invest in the exact same commodity? That's a great question. Both GLDM and IAUM offer a lower price point than their bigger brothers, especially when comparing GLDM and GLD. GLD is currently over $220 per share, while GLDM is around $47 per share. One other difference is that GLD and IAU can have options traded against them, while that isn't the case with GLDM and IAU. For most investors, that likely won't be a factor, but I wanted to make sure to detail the difference as well. Now, based on all of that information, which of these gold ETFs would I recommend to invest in? Since I consider gold to be a long-term investment, I would recommend the ETF that has the lowest expense ratio due to the fact that it can have a significant impact on your overall return over time. Based on that, I would lean towards IAUM because it has the lowest expense ratio at 0.09%. But you could also go with GLDM if you have a preference for State Street funds, since GLDM's expense ratio is only slightly higher at 0.10%. Well, that's it for this video. I hope that what we discussed helped show you how you can start investing easily in gold with gold-related ETFs without having to actually buy, store, and insure physical gold. Diversification in your portfolio is always important, and gold ETFs can help diversify in a way that's not tied directly to the stock market. As always, thanks for watching and hanging around to the end. Don't forget to like the video and subscribe so you know when I put out new content focused on your money and how to manage it best, with a little bit of comedy thrown in for good measure. See you next time.